In this video, we'll explore the descending trend line, a powerful chart pattern used in technical analysis to identify bearish trends. Let's delve into the key features of this pattern and how it can assist traders in making informed decisions. The descending trend line, also known as the downtrend line, is a bearish pattern formed by connecting two or more lower highs with a straight line that slopes downward. Technical analysis relies on the assumption that prices trend, making the use of trend lines crucial for identifying and confirming trends. A descending trend line acts as resistance and indicates that supply, represented by more sellers than buyers, is increasing even as the price falls. A falling price combined with increasing supply creates a very bearish scenario, reflecting strong selling pressure in the market. As long as the price action remains below the descending trend line, the bearish trend is considered solid and intact. Price may pull back as it encounters resistance from the trend line, leading to multiple retests until a potential breakout. The strength of a trend line is determined by the number of points that can be connected and how many market participants recognize the trend line. When many traders acknowledge the same trend line, it becomes a self-fulfilling prophecy. However, a break above the descending trend line indicates that buyer demand has increased, possibly signaling a change in trend. Traders can take advantage of this breakout, but must remain cautious of false breakouts, also known as fakeouts. And that concludes our exploration of the descending trend line, a powerful tool for identifying and confirming bearish trends. Remember to like this video and subscribe to our channel for more valuable insights. Click the link in the description to join our Telegram group and watch us trade. Happy trading!